How's it going, everyone? It's Sam. This is a monster video. I was actually going to turn this into a course. I was going to turn this into a course because it's not something that typically does that well on YouTube. People just don't care about a lot of these things, and it doesn't really fit with my audience a lot. But one of the most important things I think in life is being able to do what you want when you want, and you get that by becoming financially independent. Some people call it retiring early. And I changed my mind. I didn't want to put this behind a paywall. I'm going to just start by posting the first video, and I have about 14 different segments in here that cover a variety of different topics. The first one that you'll see here in a second is just the intro to what would have been the course. But I'm going to make it free. If you guys don't mind, hitting the like button and subscribe button if you guys like that kind of thing. Over 2 hours of content on a bunch of different subjects. There are links underneath the video for a lot of the companies I use. None of them are paying to be in this video or anything like that, but sometimes there are referrals where you get some free money, I get some free money. And also, if you want access to this kind of thing a little bit early, sometimes I do that in the Patreon. So I did give them access to this full video ahead of time. If you guys want that, you can see exactly what I buy and sell in the stock market and crypto, and get some of that content on a daily basis. But let's get into the video on how you can become financially free. How's it going, everyone? It's Sam. I wanted to start off the course by talking about why you'd want to be financially independent and talk to you about some of the topics we'll be covering. Obviously, you can see this before clicking on the video, but there are a lot of topics that we have to discuss with this. So financial independence is having enough income to pay one's living expenses for the rest of your life without having to be employed or dependent on others. A lot of people think about financial independence in another way too, which is basically that you're financially independent from your parents as opposed to being financially dependent. But how we're going to be talking about it is having the income to pay for your living expenses. Now, there's a lot that goes into this. There are a lot of questions that new people have that I'm going to answer here. So I'm going to just walk through some of them. Obviously, I want to tell you my story, talk to you about how I got interested in all this. That's going to be the next video. But then we're going to talk about the magic number, how your savings rate is really the most important thing when it comes down to your finances. Talk about how to earn more, how to save more, where to invest, what kinds of accounts to invest in, what to invest in. So how much do you allocate towards crypto versus stocks versus real estate and all that kind of stuff. We're going to talk about index funds, individual stocks, crypto, real estate, breaking those down a little bit more, what to expect out of them. Also going to talk about mentality, some common terms like buy the dip or DCA, what that means and how you should think about it. Also talk about whether you should pay off debt or invest. That's one of the biggest questions I think for a lot of new people. And then I'm going to walk you through my numbers, how my portfolio is actually allocated, why it might be different than yours. And we're going to go through relationships and money. Now, if there's other stuff that you guys can think of, let me know. Let me know, because I think that I want to cover pretty much everything people have questions on. And honestly, I think this is going to be very beneficial. I can't really include it on the channel, at least I don't think I can, because people won't like it. Most of the people that watch the channel are more interested in day-to-day activities in the stock market or the crypto market than they are in long-term investing. But I think this is really valuable. YouTube just doesn't really place a premium on this kind of stuff, at least for my channel. So I want to walk through all this. Now, why would you want to be financially independent? Well, I think it comes down to having the flexibility to do with your life what you want. And I've always been someone that, even if I didn't know what I wanted to set myself up as well as possible to get what I wanted. Like even in high school or college, I got really good grades. Even though I didn't really know what I wanted to do with the rest of my life, I knew that if I did that, it would set me up in a better position. Same thing with finance, right? I don't know what I want to do 10 years down the line. I don't know what I want to do 5 years down the line, but I want to have the money to be able to do it and not be stressed. Also, it is really nice to not have to stress out over buying flowers or buying candy for someone for Valentine's Day, and just knowing that you are in a good financial position to do that kind of thing. Now, for some people, they don't care, right? Some people, they say, hey, I have the money, I'm going to spend the money. But for me, I'm a planner. I like knowing that I'm on the right track, and I like knowing that I'm making progress. And if you're watching this, you probably are the same way. And I should say this too. a lot of this is going to be personal. A lot of it's going to be dependent on you and your position and where you are and where you're going. My story is not your story is not my story. When you hear some of my numbers, they might sound huge and like they just can't be achieved. For other people, they hit my numbers years ago, years before I did. So it's going to be dependent on your own situation. Also, some of the kinds of accounts that we'll be talking about are going to be relevant more to US investors because of the fact that we are talking about US accounts, but there are similar accounts in other countries, so some of it might be dependent on you specifically, and some of the returns might be dependent on where you live, right? Real estate investing in New York is very different than real estate investing in the Midwest. So some of this stuff is going to vary, but I think this will give you the principles that you need to go on and complete a lot of your own financial goals. So that is why I get so excited about financial independence, because it gives you the ability to do with your life what you want to do. So that's enough of that, but let's talk a little bit about my story, why I got introduced into this, why I got interested in this, and let's move on from here. How's it going, everyone? It's Sam. I want to take the next video and tell you about my story a little bit, why I'm interested in finance, why I got into it, and just give you a little bit of background before we get into the meat and potatoes of the course. Like I said last video, financial independence is the ability to do with your time what you want and not be tied down to a job. And that's something that I've always been interested in, but I didn't really know was possible early in life. I didn't realize that you could retire at pretty much any time, assuming you hit a couple different criteria. Now, a little bit of background on me. I was a really good student in school, over a 4.0 in high school, and then nearly a 4.0 in college, about 3.97. And I was studying medicine at a Big Ten school. I was all ready to go on to med school because honestly, I just thought it would pay really well. It was a nice challenge. And I realized in my last semester, I really didn't care about medicine. It was just, like I said, it was a good challenge. It was going to pay well. But I realized I probably couldn't keep going because I just didn't have any passion for it whatsoever. So at that point, I realized, okay, I'm $115,000 in debt. I'm looking at a job and I have no idea what that will be, but I'm looking at getting a job that will pay me probably $40,000 a year with my education. And I had this crippling debt at the same time. So I realized, okay, if I'm not going to be making $200,000 a year, I need to figure out what to do with my money. So I moved back home with my parents. I got a job at a local retail bank. And that, if you don't know, that's the kind of bank that you walk into. It's not the commercial line. It's not the investing side of the bank. It is the person that you would walk into if you have to open an account or something like that. Now, this was paying about $18 an hour when I started, which honestly I was happy about. I thought I was going to get $15 an hour or something like that. So I was making $18 an hour, about $38,000 a year at home with my parents. And at this point, I was really interested in finance because I had done all this research because I had no idea what to do with my money and how to actually become wealthy. It's obvious how to become wealthy if you're making a ton of money, but for most of us, we don't know how to do that if we're looking at $30,000 or $40,000 a year. Now, I stumbled across this website. This is called MrMoneyMustache.com. I know it's kind of a crazy title, but I found out about the 4% rule. I found out that you can retire early. And at the time, I was so excited about this. This guy retired before 30, I believe, or maybe it was right at 30, and he retired with $800,000. First of all, how do you get $800,000? And then second of all, how do you retire on that? And I was just enthralled by this. I was looking and reading everything I could about financial independence, retire early. It's called the FIRE movement. And I just felt like I had found the gospel. I felt like I had found the golden goose, or I had found the secret to life. And I tried to tell all my friends and family about it. I told my girlfriend about it. No one really cared. They kind of like patted me on the head, said, that's nice. That's nice for people that can save 50%, but that's impossible. Or that's nice that some people retired early, but we're not even making money, or we're already older than that. But for me, I felt like I was in the perfect position to learn about this, and I was so excited. So that's when I actually started my YouTube channel. At the time, like I said, I was making maybe $36,000 a year at work, maybe 37, 38. I was working my butt off. We worked 4 10-hour days. I was also working, and I owned a personal training business where we went and coached high school athletes. My dad and I did that, and that made a decent amount per hour, maybe 30 to 70, even $100 an hour at some points, but it's for maybe a couple hours a week. So I was making maybe $5,000, $6,000, $7,000 from that a year, but that was at all weird times. It was after work, so I was working like crazy. I was also making some YouTube videos, but at the time I really didn't put that much effort into it because I didn't think they would really go anywhere. It was just an outlet for me to explain thoughts I had and some exciting things I was learning. So at that point, I was just grinding away, and then the pandemic hit, and I had been literally listening to podcasts and YouTube videos and reading in all of my free time. Like, I took a shower, I'd listen to a financial video, like on my phone. If I was driving to work for 5 minutes, I'd be listening to podcasts. And like I said, I was listening to it 24/7 in my free time. Most people watch Netflix. I watched finance videos on YouTube. So I started to make videos about investing in individual stocks around the time of the pandemic, because up until that point I had invested only in index funds. But with so much craziness happening in the world, and with so many great companies really getting beaten down during the pandemic, I started to learn a lot about individual stocks, and I started to make videos about it. So things kind of took off from there. I started making money on YouTube maybe 4 months after the pandemic hit. I was making videos almost every single day, maybe every other day at that point. And then I was sent home to work from home. Well, actually not even work from home. I was just sent from home because I'd recently had pneumonia during the beginning of the pandemic. So they sent home a bunch of people at my bank, and I started making YouTube videos every single day, and it was kind of a jumping off point for me. It was probably the best thing to happen for me and the worst thing to happen to the bank if they wanted me to stay there, because I was able to start making an income from YouTube. And it started at about $1,000 in the first month. Not a ton of money, but for me that was super exciting. Making money online obviously was exciting, but $1,000, that's 1/4 of my salary in the first month. And then it turned to $2,000 the next month, and $3,000. And I'll go through some of the numbers later too when I go through my portfolio, but I'll just do a little bit here. So $1,000, $2,000, $3,000, then it went up to $10,000 the next month, and then $10,000 again. And I decided that was the time that I wanted to quit from my day job. I was making $4,000 a month from my day job at that point. I'd gotten some raises. So $4,000 a month, about $50,000 a year. I quit when I was making $10,000 a month on YouTube. And then things kind of dipped a little bit, but they recovered, and I started making more and more money over time. I started making money that I didn't think I was going to make in a year, I was making in a month. So things took off from there, but every story is different. I think the important thing is to make sure that you have the fundamentals down, and that's why we have the course. That's why I'm making videos on all this different information, because it's really important to know how to invest. And a lot of people are investing the wrong way starting off. They're either being way too risky, or they're saving instead of investing, or they just have a ton of questions and it can overwhelm them completely. And I think that is why we need to have an open dialogue about these kinds of things. So we're gonna start the next video here in a second. I just wanna say, thank you guys for being part of this. I hope that gives you a little bit more backstory on me specifically and why I got interested in this, and why I have such a passion for it, because I do think that this is the key for a lot of people, and it will make so many lives better just knowing about financial independence. Okay, so the big question that so many people have when they start looking at financial independence and trying to figure out when they can retire is, how much do they actually need to retire? It's not real clear at first. Different experts say various things. Some people say you need 5 million or 10 million to retire. Some people say near $1 million. Some say 80 or 90% of your annual pre-retirement income, or 12 times your pre-retirement salary. All this is BS. There's one specific thing you can take a look at that will tell you about how much you should need to retire. And it's going to be different for everyone. You can't just say $1 million, because $1 million for someone that lives in New York is going to be very different than $1 million for someone that lives in the Midwest. What if one person has a paid off home? What if another person has a boat and 3 cars and a house? Just because they have that doesn't mean that they can't retire. Now, before we show how much you actually need to retire, I think it's important to realize that you need to have this invested. Let's say you worked for 40 years and you were able to save $25,000 a year, which is a huge amount. Most people can't do that. Let's say you retired in 2011. By the time, right now, about 10 years later, you would have only about $830,000 worth of purchasing power. So you had $1 million 10 years ago. Now it's only worth $830,000. And you have to remember, 50 years ago, when you're saving $25,000, that was an insane amount of money back then, and it was worth a lot. But now, as time goes on, we just inflate more and more each year, and your actual purchasing power, how much money you have, or the value of the money you have, is going down constantly. So you can't just save and put it in a bank account. You have to actually invest your way towards financial independence and retiring early. If we do the same scenario, you were able to put in $25,000 a year for 40 years, you would have about $3.8 million. So that's accounting for inflation. You would have $3.8 million as opposed to $1 million. So that's a huge difference. Same scenario again, but investing about $25,000 a year. Now, some people can't do $25,000 a year, which is why I want to talk about how much you actually need. Well, we're going to assume that you don't get any kind of Social Security. Social Security, we don't know if it'll be here when we retire. I don't really like to account for it. And if you're retiring early, you're not going to get Social Security for a very long time. So I go by something called the 4% rule. Now, there are some people that say that should be 3.5%, 4.5%. Basically, how this breaks down is you need your annual expenses to account for about 4% of your portfolio. So let's say you have $1 million, you can only spend about $40,000 a year. What they did was they took a look at all the previous time periods of about 30 years, and they were able to break it down that there's about a 96% chance that you will have enough money after 30 years to be able to continue to have a portfolio. So let me explain that a little bit better. So if you take 4% of your portfolio, let's say you have $1.5 million, 4% of $1.5 million is $60,000 a year. You can take out 4% of that, $60,000, and you can take that out with a 96% chance of certainty over the time periods that they looked at, that there was a 96% certainty that you would not run out of money after 30 years. Now, some people say that you should actually have a lower amount than that, like 3.5%, because if you're retiring early, that means that you have a longer time span than 30 years probably. So if you retire at 30, you're probably looking at 50 or 60 years in retirement. But this is a good way of starting. And I think 4% is pretty safe because most of us will do something to make money, even if it's something small or on the side, or we'll come down with a windfall or something. But still, there's a very, very, very high chance that you'll not run out of money after that 30-year period. Now, one website that I like looking at is firecalc.com. You can search for it. Basically, you can start here. You put in your spending amount, your portfolio, and then how many years you have to retire. So the longer that you're actually retired, the more the portfolio fluctuates. So this is a Monte Carlo simulation, runs a bunch of different simulations. So after 50 years, your portfolio would be somewhere between negative $3.2 million and $26 million, with the average about $5 million. For the purposes of this, out of the 100 different simulations they ran, 23 failed with a success rate of 77.2%. Now, if you go back and you do it for a shorter time period, let's say just 30 years, right? Well, now you have a 95% chance of success. Now your average is lower because, again, there's less time. So in really good simulations, it's not going to go up as high, but in bad simulations, it's not going to fall down as far. So you basically have to figure out how much you're spending, how much you think you'll spend in retirement too. It's not an exact science. It's difficult because you don't know how taxes are going to move in the future too. We'll get to accounts later that you can invest in, but you have to take that into account, how much you spend each year and how much you think you'll spend in retirement. and then multiply that number by 25 for how big your portfolio has to be. Now, from there, you can just go to an investment calculator, figure out exactly where you're at. Let's say you have $10,000 saved right now, and you want to retire. Let's say you're 25 and you want to retire by 50, and we're just going to say at normal rate of return of about 7%. We're going to say not that amount, but $10,000, not a million. We're going to say that you're able to invest $5,000 a year, and you want to be able to have $1.5 million in the bank. Let's see if you can make it. No. So at this rate, you need to invest more. If we go for a longer time span, that also helps. So let's say you said, okay, we're actually okay with investing and then retiring when we're 55. Well, that would get you about $548,000. Otherwise, you might have to invest more, right? Let's say you can do $15,000 a year. Well, that's obviously going to help you retire a lot faster. That would have you hit your goal after 30 years. If you don't hit those numbers, right? If you can't invest more, you have to save or you have to spend less, right? You either have to make more or you have to spend less, or you have to lengthen out your time span. And of course, there are market fluctuations. This is not perfect science. After 30 years, there might be a market dip the year that you're trying to retire. So you have to be a little bit flexible. Now, one thing that I really liked when I found it out was this. This basically breaks down, depending on your savings rate, how long you have until retirement. This is all you need to know. Honestly, of course, like I said, there can be market fluctuations, so it might change a little bit. But whether you make $1 million a year or whether you make $100,000 a year or $20,000 a year, this is what matters. Not how much you make, but how much of what you make you actually invest. So if you save, let's say 10%, or you invest 10% a year, it will take you 51 years to retirement. Let's check that out. Let's make sure that's right? So let's say you have 50 years. We're saying you have 51 years, and let's say you make $100,000 and you are able to invest $10,000. Okay, so that means you would have about $4.4 million. So we said that you would need about $90,000, right? Because obviously if you spend $10,000 of your $100,000 salary, you are spending about $90,000. So 90,000 times 25 is about 2.25 million. So that seems a little bit off. That's because they take some assumptions, which is you only have about a 5% rate of return. So that brings us to that $2.2 million. That's exactly what I have on here. So you can play around with the numbers a little bit. If we actually went up to that 7%, let's see how many years you'd have to work instead. So instead of about 51 years, it would be about 41 years, assuming 7%. Now, they are a little bit conservative. I like that a little bit, but let's say you move up and you're able to save 25%. Well, you have about 32 years to retirement. If you're able to bump that up to 50, it's only 17 years. If you started at 23 and you saved half your income, you should be able to retire by about 40. Now, the cool thing about this is not only are you investing more when you increase your savings rate, but you're also spending a lot less. So it helps in multiple ways. Now, it doesn't account for everything, right? This is assuming you're starting from zero. This is assuming you are getting about 5% return. There are a lot of things that they take into consideration here. And they also don't take into account that maybe your spending changes a little bit in retirement. Let's say you're working and you're just extra stressed out. So you're eating out more. You're also spending a lot of money trying to go to the gym. You're also taking really expensive vacations to make yourself feel better about working. Well, your savings rate would come down a little bit, but hopefully once you're retired, maybe you make a little bit of money on the side, or maybe you don't make any money, but you're just not stressed out and you don't have to spend all that crazy amount of money, which means that you would actually be living on less after you actually retire. So this is something I think is really important. I like to think that if you can bump this down, bump up your savings rate and keep on falling down the ladder further and further, it's only going to help you. It also doesn't, one other thing it doesn't take into account is maybe you were at 15 and then maybe you bump it up. It doesn't take that into account, but if you can move down and save more and more, that's going to be huge for your savings goals. Now we'll talk about how to save more or how to earn more in the future videos, but these are really the important numbers. The 4% rule, also called the 25x rule in some circles, but basically you need to be able to have 25 times your annual expenses in retirement accounts. And then also, I really just like this graph here. Maybe you can pause it, figure out where you're at, but you have to figure out your expenses and figure out how long it will take you to get there based on your savings rate. Thank you guys, and let's get into the next video here. Okay, so now you know how much you need to retire. There are a couple different things you can do. First of all, to get there faster, you can either invest much better, right? You could get, instead of a 7% return, you can make a 10% return. A lot of the time that's a fool's errand though. And I realize I talk about how I'm investing on the channel, but it's very hard to outperform the market. So that's not what I want you to focus on at first, right? Because it is much easier to earn more than it is to invest better at the beginning, especially if you're someone young, maybe you haven't made that much money yet. It's much easier to spend more time actually figuring out how to make money. And let me explain why. So let's say you have $1,000 to invest, right? You saved up for a full year, you invest $1,000. You spend all this time trying to learn how to invest. So you get, instead of a 10% return, you make a 12% return. So you do all that work, you multiply this out. So at the end of the year, you have $1,120. So you spent a ton of hours. Let's say you spend 50 hours on YouTube, and I feel like that's not that much. That'd be 1 hour a week. So I know I spend more than that, but you spend 50 hours. Well, that difference between what you would have made, let's say you would have made about 10% or so, that difference is only about $20. So I'm kind of, this is interesting because this is something that I talk about a lot on the channel, but you made $20 for 50 hours of work. That means you made about 40 cents an hour, which is not good. That's horrible. That's 20th of what you would make at a minimum wage job here in America. If instead you spent 50 hours either just earning more money, let's say you did go work at a minimum wage job, 50 hours times $8 or $9 an hour, wherever it is now, that's $400 or $450. Let's say you spend it towards learning how to make more money. That you can actually extrapolate, and you can use that for everything that you're going to do, all the hours that you would normally work. So if you can make, let's say, $1 more an hour after spending that many hours learning, or let's say you can make $5 more an hour, or you have a side job or something, that's going to be huge. And I think I should just show you this graph. This is something that I made a video on at one point on my channel early on, and it's something that I felt like was a really awesome realization once I figured it out, but it didn't do well. No one really watched it because it wasn't my normal type of video, but I think it's really valuable. This is how to make money. If you want to make money, this is how you're going to do it. So we're going to have two different variables. People, so the number of people, right? Right here, number of people. And then we're also going to have the value you bring them. And I haven't seen anyone else break this down. Maybe Tony Robbins at one point talked about it, but I don't think he did either. If you want to be rich, this is how you do it. You have to be above this line right here. If you're above this line, this is awesome. You're cruising. You're going to make tons of money. If you're below it, you're going to be you're not going to be very well off, typically. So what is this line? What is this line that divides the rich from the poor? Well, obviously there are certain circumstances we can't take into account here, but this is true for the majority of people. The number of people that you can help is important, but you need to look at the value you bring them. So let's say you work with one person. Just because you work with one person in a day doesn't mean that you're going to be poor. If you can bring them a ton of value, think about doctors, right? Doctors aren't going out and performing 5 surgeries at once. They're working on one person at a time, and they bring them immense value, probably even further up, like up here, right? They're bringing value that no one else can bring. It's highly specialized, but they bring a ton of value, and it's with something that people are willing to pay a ton for because it's health related. They need it done, and very few people can do it. Let's look at something else. Let's say you're a YouTuber, right? You're a comedy YouTuber. Not even what I do, but you're comedy, right? So let's say you can reach 1 million people. So 1 mil, this is hard writing this, but 1 million people, right? You're bringing just a small amount of value. Like, you're not changing anyone's life. They're not going home and feeling like they've come up with some great idea for anything. They're not really improving life that much, but they do improve life a little bit for a ton of people, a small amount, because they make their day a little bit brighter, right? So they're offering some value, but not a ton compared to a doctor, right? But they hit a lot of people's lives. That's how you make money. You either have to help one person really a lot, or hit a lot of people, maybe not bringing as much value, but help a lot of people in a small amount. Otherwise, there's all this in between, right? Let's say you're a really successful gym trainer, and you can train, let's say, 50 people at a time, 50 people, and you offer them a ton of value compared to what they're used to, right? You could offer, let's say, 50 people $20 an hour. That's $1,000 an hour. For a year, that's $2 million a year if you could do that every single hour. So 20 people times $50 would make you a ton of money. Let's say you're someone that, you're a comedian, right? You actually go to shows. That would, I think, give you more value than something like a YouTuber, right? Because people come out, they have a good time, and you're talking to maybe 20,000 people. You're over here. Now, if you can get higher on this, that's great. If you can provide a ton of value to a ton of people, that's how you make an insane amount of money. The people that don't make that much money are down here. They're helping either not that many people, not that much, or they just are easily replaceable, right? I mean, think about people that don't help that many people. Maybe, like, I say this because I work this job, like a bank teller, right? It can be automated, but typically people like it a little bit more if they can get their cash out in person, or maybe you can deal with a couple more issues than ATM, right? You're helping a few people at a time. Maybe you've helped 50 people, but what you're doing isn't that difficult and isn't that valued by society. So you're down here. And that's where I was. I've changed my income a lot, and this is nothing against like bank tellers. My fiance is a banker right now. I have a lot of friends in the business, but that's how you get really wealthy. And it's going to be different for everyone. How can you provide value to a lot of people and provide a good amount of value, right? The goal is to hit more people, or to help more people, or to provide a lot of value to the few people that you do work with. And that's something that I think on YouTube is something that's really scalable, right? Let's say you provide the same amount of value. Hopefully it gets a little bit better over time. Like, I think I'm a better investor and a better YouTuber than I was 2 years ago. So let's say you provide just a little bit more value over time, but you hit more and more people, right? Your channel grows and grows and grows, and you become wealthier and wealthier. That is how you make a lot of money. Hopefully that helps. I mean, I realize that that's not the most concrete way of talking about how to make a ton of money, but you have to make more money somehow, and you can grind it out working for someone else, right? Like driving an Uber or Lyft. You can make more money, but you have to go invest it to actually make a difference in your life. If you want to do it yourself, you have to look at this graph. This is, I think, one of the most important things in the world that no one really thinks about that much, I think. I think it just kind of happens for a lot of people. They either help more people or they provide more value. I want to hear your opinion about this, though. I believe there's a comment section underneath, so let me know your thoughts on this. And I've been someone that has worked for, $8 an hour, $7 an hour, and now working on my own, I'm making way more than that. So I have seen everything in between, I think, too, but I think this is a great way to start thinking that will hopefully help you increase your income. Now we're going to talk about how to save a little bit more money and what goes into that. Okay, so we just talked about how to actually make more money. Now we have to talk about how to spend less. And I'll be honest with you, after you start making more money, this becomes less and less important. The reason I say that is after you make, let's say, $100,000 and you're spending, let's say, $30,000, just to be really extreme, to make it really obvious, it's a lot easier to make an extra $10,000, go from $100,000 to $110,000 compared to going back and trying to cut another $10,000 out of your budget. It's much harder to do that once you've already cut down a good amount of expenses. But I think early on, it's probably easier for most people to cut expenses because it's really obvious how to do that compared to earning more money. Earning more money, I think, is much more beneficial over the long term, but it's more difficult to figure out how to do that at first. And something that I didn't cover in the last video, but there are side hustles. You can always ask for a job or ask to get more from your job. You can always switch jobs, stuff like that. But let's get to some of the expenses in America. Obviously, if you can cut out some really high interest debt payments, that's going to be key to actually cutting down on your expenses and refinancing some of those, going to a bank, asking for a loan, going through that process. If you have a high interest rate, that's a great way of cutting it down. Now, some people can't do that, but if you have equity in a house, or if you have some way that you can get a loan instead of, let's say, putting on a credit card or a payday loan or something like that, that's really beneficial. Now, I realize this isn't going to be the same for everyone, but average annual household expenditures, $1,800 for your housing. So that is a significant amount. This is of your annual or your average pre-tax household income. That's 25%. And that's obviously, like I said, pre-tax. So this is a significant amount. If you can knock that down, that's great. That's one of the easiest things to knock down. If you can do something called house hacking, which is where you buy, let's say, a duplex, you live in half, and then you rent out the other side. Let's say you buy that for $200,000, and then you can get $1,000 rent from the other side. You pretty much can cut out your entire housing payment. And I realize for some people that's not a possibility. I realize some people can't afford a down payment too. But if you're looking at retiring early, you have to make cuts somewhere, right? So usually starting with some of the biggest items are some of the difficult things to do mentally, but will make the biggest amount of difference. So housing, shelter. I'm not exactly sure what shelter is here, honestly. You would think that would just count as housing. Transportation is another thing. It's about $820 a month. If you can cut down on your car payments, again, just getting a less expensive car or a more dependable car. Food is $610 a month. Honestly, that is, 90 meals a month. That's about $7 a meal. If you can cut that down, that's great too. Save a couple $100. Pensions and personal insurance, stuff like that, cut that down. If you keep on going down the line, you figure out that it costs about $5,111 for the average annual household expenditures. Some of this isn't going to be applicable to everyone. If you don't smoke, you're not going to count tobacco. If you don't drink, you're not going to count alcoholic beverages, stuff for kids, stuff like that. So there are places to cut. This is just the average. And when you look at this, the average pre-tax household income is about $84,000. So this is pre-tax. Let's say you're taxed at 20%. Well, that means there's only about $300 or $400 left for saving towards retirement. And I realize some of this stuff is included, like they talk about Social Security and pensions, but only about $300 or $400 in monthly spending money outside of this budget or investing money. So if you can cut down on housing, that's going to be a huge part of it. Transportation is a huge part of it. Food, I like food a lot, and I think it is important to get some of the right food in your body. And then obviously you can't skimp out on things like healthcare, but if you can get some kind of deal with that, that's great. So I think you have to start looking and cutting really ruthlessly. Make sure that you actually write down how much you spend, and maybe do this over a 3 or 6 month period. I recorded how much I spent for years. Only until recently did I stop doing that. But I think that's really important because some things come up once every 6 months, once a year. Let's say you spend a ton of money on Christmas gifts every year, or you have property taxes twice a year. It's hard to remember everything that can come up that you have to chop up into monthly payments, right? Let's say, again, you have a $4,000 property tax payment. Well, that's $333 a month. So you have to take into account some of that stuff. So you have to break down your budget, figure out where you have more bloat or more fat than you should, and then try to cut that down. Now, I have spent a lot less. Like I said, I've spent a lot less time trying to figure out my budget. I don't even track it anymore because right now it is such a small percentage of what I make. It's more important for me to focus on income at this point because I'm saving over 90% of my income, and that's post-tax. So I really have to figure out how to make more money and not how to save more money at this point. But if I flip the switch and I want to quit today and I wasn't making any income, where I'm spending my money would be the important thing. So that's how you save more money. Again, hopefully that helps. Hopefully you can dial down on some of the specific things you spend money on. A couple different things that I like, maybe little things, but Rakuten, I'm not even going to include a link to it. I do have a referral link, but you can just go figure it out, and you can save money. So you get about 2% to 20% back or $10 back, and it's just a browser extension. It's kind of nice. Like I said, a small little thing, but can save you some money. They send you a check every 3 months. So check out that. Again, not sponsored, and I'm not going to include an affiliate link, but that is something that's nice. Honey does something similar, but it's a little bit different. I like Rakuten a little bit more, but hopefully that's helpful. Thank you, and we'll get into the next video. Okay, so now you have some extra money coming in, you're saving a little bit more, and then comes the first question that so many people have, which is, should I pay off debt or should I invest? And there are a lot of factors that come into play here, and everyone's situation is different. Everyone's risk tolerance is different, but I want to give you my general thoughts. And I've actually made a few videos on my channel about this before, I believe, but let's take a look at it. So first of all, people want to know, okay, should I pay off debt? Because that way, when I pay off my debt, I have more freedom. Also, then I can focus on investments more. And let's say I have a $200 a month credit card bill or $200 a month student loan interest bill. I could use that $200 then to invest if I didn't have that loan coming through or that payment coming through each month. The real thing that I take a look at is, what is the interest rate? That's the first thing. That's the biggest part of this. If you have some kind of payday lender loan that costs, $100, or I should say like 100% a year or 200%, some are even higher than that, pay that off first. That, just get it out of the way. If you're in payday lending schemes, always pay that off first. Then from there, if you're in severe credit card debt, I would pay that off as well. Now, there is a caveat to this. Let's say you have $1,000 on a credit card and you're just making minimum payments, you have interest on there, but you could pay it off, or you have a 401k that gives you a match. I think that is where you might consider at least getting the match in the 401k. So we'll talk more about 401ks in a bit, but a lot of the time, employers will actually give you a match on that. So let's say you put in 4% of your salary, they might match that 50%. So they might put 2% of your salary in the 401k as well, or even they might match 100% up to 4%. So you put in 4% of your salary, they match you with 4% as well. I think that actually sometimes makes more sense than paying off the credit card debt, because it doubles your money. You get no return, let's say in the stock market, you just put in the money in there, and you're getting 100% return. Now, even if you took that money out and got all the penalties on it, you would still have more money than that credit card would have cost you. Now, if you're in a severe circumstance where you're drowning in credit card debt, just get that rid of first. And then people want to know, okay, how do I pay it off, right? Do I pay the large amount off? Do I pay the smallest amount off? Do I pay the highest interest, the lowest interest? Dave Ramsey actually talks about this a good amount. He talks about the debt snowball. This is something that I don't really believe in. He believes in it because it is more of a mental thing than anything else. And that's paying off the smallest amount, the smallest loan first, and then moving to the next smallest and the next smallest. So that way, when you get done with the first payment, let's say you have a $20 a month payment, a $50 a month payment, and a $1,000 a month payment. When you get done with the smallest amount, you can roll that into the next and then into the next, and it seems like it's going faster. There's another line of thinking that is that you should pay off the highest interest rate. The highest interest rate would give you the most bang for your buck. It would save you the most money and is mathematically the better choice. Now, the reason that they use a debt snowball for Dave Ramsey is just because mentally it helps people. They can see one less payment coming in. It was the quickest one. It's really hard to change habits too. So if you can get the first payment done with, you're going to feel good and you're going to want to keep that going. Now, for me, I like the debt avalanche, especially as the range of interest rates becomes higher or further. Let's say you have a 4% and a 8% interest rate. I would much rather pay off the 8% interest rate, even if I have a much larger balance. Let's say it's $20,000 at the 8% interest rate than $2,000 at the 4%. I'd much rather keep on putting money there because that actually decreases the amount of interest I have to pay. Now, from there, let's say you pay off all your loans. Let's say you go with the debt avalanche. Should you actually pay off some of the lower interest rate loans? Well, I think it doesn't really make as much sense to pay off when you're getting into the 5 or 6% range. Especially with inflation, this is one way to think about it. Inflation's 8% here in America. If you have a 6% loan, you're actually getting free money because inflation is just taking away the value of that loan. So imagine you start getting pay raises to keep up with inflation. Well, that debt is actually worth less now. It's actually helping you that we're inflating away, assuming your salary goes up as well. So that's kind of an interesting way of thinking about it. I can go into much more depth, but we'll just keep it that. If it's under 6%, I think it makes more sense to invest because typically you should be expecting an 8 to 10% rate of return on investing in like an index fund, as opposed to a 6% rate that you'd have to pay, or a 6% interest rate on a loan. Now, some of this depends on where you are in your retirement. So let's say you're 56 years old and you're going to retire at 60 and you still have some higher interest rate debt. Let's say it's student loans and they're at 5.5%. Well, then you might want to consider just the fact that there is more safety. So if the stock market dips and you've been putting all your money in that, well, you're trying to retire, so you're going to have to start pulling money out of that, compared to if you just go with the easy student loan interest or paying off the student loan, that will give you a guaranteed rate of return. So that is worth something, right? A guaranteed rate of return is better than a non-guaranteed rate of return at the same amount. So that's something to consider. Also, your portfolio would probably be a little less risky, would probably give you less returns at that point. So maybe instead of an 8 to 10% rate in the market, what you would expect to get, you might get 6 to 8%. So then you might want to consider just paying off the debt as well. Now, sometimes it actually is beneficial too to have a little bit of debt for tax reasons. The way that I look at it is you can pay, or you get a tax deduction on some of your student loan interest. So for me, I get a federal tax deduction. I am actually keeping some of my student loans. I have more than enough money to pay off my student loans and my fiance's student loans. Some people just say pay it off. For me, it's a small payment compared to what I'm making. And because you actually get to write off $2,500 per person each year in student loan interest, that means we get another $5,000 deduction. At our current tax level, that actually saves us about $1,500 or $1,600 a year, plus the interest rate's only at 4% or so. So right now, I am not paying that off early. I would much rather just let it sit for the next 10 years and then continuously just pay interest on it, because it is such a low price that I have to pay, and I get tax deductions on top of it. So the real rate of that student loan interest is like 3%, maybe even less than that, because of the tax deductions I get. Now, again, just to summarize, I think, first of all, pay off any payday loans if you have that. That's a terrible thing to get into. Also, if you have any other kind of personal debt that might cause you to go bankrupt or anything like that, or just really excessive credit card debt that you can't seem to get over, try to pay that off. If you have smaller credit card debt, like a few $1,000s, and it's really not that big a deal, at least match up until your 401k match if you have that. So just get that match and then put the rest towards the credit card loans. If you have something that's 8 to 10% interest, I would pay that off as well after you get your 401k match. If it's below 6%, I would focus more on investing and then just paying the minimum, especially if it's 4 or 5%. If it's a home mortgage as well, the same thing, but there are different considerations, tax considerations, retirement considerations, and it's going to be dependent on your risk level. Some people just don't want to have debt. It keeps them up at night, it keeps them anxious, and I think a lot of it is just based on you personally, but this is how I would approach debt versus investing. Okay, so now we've talked about how to make more money, how to save more money. We have some money coming in that we can invest somewhere. The question is, where do we invest? And not what do we invest in yet, because that comes in a moment. That's going to come in the future videos, but where do we actually invest? If you're someone that hasn't started investing, there's so many different platforms you can use. And there's so many different kinds of accounts that you can invest in, especially once you start working your 9-to-5 job. So the question is, where do you start investing? Well, there are a lot of different apps, like I said. Depending on what you're trying to invest in, you might use different ones. If you're buying cryptocurrencies, you're going to use different apps than if you're investing in fine art or the stock market. So generally, if you're just looking for a good stock app, I really like Fidelity. I do use Webull and M1 Finance too. They all have different features, and it's going to be dependent on what you want. But for a new beginner, something like Fidelity is nice because they offer a variety of different account types, which is what I really want to cover in this video. But if you're investing in something like cryptocurrency, I use a variety of different apps, again, depending on what I'm trying to get. So I use Voyager Digital, or Voyager app. I also use BlockFi. I also use FTX. I use Trust Wallet. And as you go along, you see the use case for different ones. Some, for cryptos, for example, some different apps will give you interest, or some different apps will allow you to buy cryptos that you can't buy on other apps. For the stock market, it's much more simple. Almost every app allows every kind of stock out there. Excuse my screen here. Fidelity does let you buy over-the-counter stocks, which doesn't come up too often, but there are some stocks that are smaller and riskier. They're called over-the-counter, OTC, and Fidelity allows you to buy those. So I do like Fidelity. If you're in the US or in other countries too, Fidelity is pretty big. So where do you invest after that? Like, what accounts do you put it in? Almost everyone, I think, has probably heard of 401k. So that's an investment type here in America. And the HSA, maybe you've heard of that, a health savings account, or an FSA, a flexible savings account. We also have IRAs. I didn't mean to pull up the specific one, but IRAs here in America, traditional and Roth, maybe you've heard of that, and then brokerage accounts. These are some of the most well-known accounts, and there are other ones for government employees. There are pensions. There are teachers that get special accounts. So we're just going to cover these 4 or 5 here today. So we're going to cover 401ks first. We're going to talk about HSAs and IRAs and brokerage too, but you have to realize some of this is going to be dependent on your tax bracket, what you might want to invest in first, and then also depending on if you even have access to these accounts and what do you think is going to happen in the future. So let's break down a 401k first. So this is going to be some tax wording, but this is not tax advice. 401k allows you to invest in stocks. It's like a basket, so you can put different things in the basket. It doesn't matter if you're buying, you can buy all different kinds of stocks in here. This is just the account type that you're buying it in. Same thing with the HSA or the IRA or brokerage account. So you can buy all the different stocks you want inside them. But a 401k allows you to invest typically before taxes. And why that's important is if you have $100, let's say you're being taxed really heavily. Let's say you're in a high income bracket and you're taxed 30%. If you have $100 and you invest $10 before taxes, that brings down your taxable income to $90. So then you're being taxed 30% on that $90, which is less tax, and you can allow your investments to grow. For early retirees, usually it makes a lot of sense to invest in these before taxes, because if you're making a lot of money now, you probably won't need as much money in retirement, hence you'll be in a lower tax bracket, if that makes sense. I hope that does make sense. If you have comments or questions, leave them underneath the video. But there are these 401k accounts. A lot of the time the employers will match you a certain amount, if you've ever heard of a 401k match. So if you have a 401k, let's say you put in 4% of your salary, they might match you 100% up to 4%, basically meaning that if you put in 4%, they'll also match that and give you another 4%. So I always suggest to go up into the match at least before you use any of these other accounts. So that's almost like a 100% return right away. And if it's a 50% match or something like that, I still think it's worth going up until that match. Some companies even give free percentages, so they might say, hey, we'll give you 4% to your 401k no matter what. Then if you put in 4%, we'll put in another 4%. Some of the companies are a little bit more generous in that way. You can also do something called a Roth contribution to 401ks sometimes, which means that you can pay after-tax dollars to your 401k. So if you earn $100, you would still be taxed on that $100, but that means that in the future, when you try to withdraw from it, that means that you won't have to pay taxes on it at that point. So there are different use cases for each. And that's the same thing with an IRA. Some people like Roth more because you don't have to pay taxes in the future, and you know that you're already finished with all your taxes. If you think taxes are going to rise in the future, or you think you might be in a higher tax bracket later in life, then it makes sense to contribute to the Roth a lot of the time. If you think that you're a really high income earner now, or you think taxes are going to lower in the future, or you just think that you're not going to have to withdraw as much money when you retire, right? Again, if you're making $300,000 a year now, you want to retire in 5 or 10 years and you want to live on $100,000, that might make more sense to try to get that tax deferral now. So that is what a 401k is. An HSA comes in if you have a high deductible health plan. So you have to be a high deductible health plan. A lot of health plans I think are high deductible, but you have to be cautious about your specific plan. And I was in that high deductible health plan. It's really easy to figure it out, but you can kind of see it here, how much you can contribute. All of these have different contribution limits, by the way. Like there's a certain max amount. You can just type in 401k max contribution or something like that. But the HSA is a really good place to invest because they allow you to invest pre-tax, just like the 401k. But if you use it for health issues or health-related expenses, you don't have to pay taxes on it later either. So you can put in, again, let's use that same scenario where you make $100, you put in $10 into your HSA. Let's say sometime in the future, you have to pull that money out. You were never taxed on it on the front end, so it brought down your taxable income to $90. And then when you use it for something health related in the future, you don't have to use it and pay taxes on it then, or you don't have to just pay taxes on it then. So you can use it without having to pay taxes. So this is one of the only accounts here in the US where you can pay or not pay on the front end and not pay on the back end. So that's really useful, especially for people that are going to be early retirees. I would suggest putting a significant amount of money towards this, because the cool thing is you don't have to pull the money out right when you have those health expenses. Let's say you start investing really heavily at 22 years old. You max out this HSA every year at $3,650 starting now, and then by 35 you retire, but you had a couple different surgeries. Maybe you blew out a knee or something like that, and it costs, let's say, $20,000. You don't have to take that $20,000 from your HSA. You can keep on letting it grow, and then when you're actually ready to retire and you're looking for some passive income, or you're looking to take money from your investments, well, you can take the money out then, and then you don't have to take money out of other accounts and be taxed on it, which is really nice. And something else to consider is you can have a little bit more flexibility in HSAs in that way. With 401ks, you have to wait until 59 and a half to start withdrawing from them. So if you're an early retiree with a bunch of money in your 401k, you can't actually access it for a long time. Then we have IRAs, which are individual retirement accounts. These are something that you can invest in even if you have an employer and you're investing in a 401k. These are lower contribution limits than something like a 401k. They're right around $6,000. They might have moved up a little bit. 401ks are higher. The employee side of the 401k is, I believe, over $20,000 this year. And then IRAs, again, somewhere around $6,000. You've probably heard of a Roth IRA before. This is the same thing as what we were talking about with 401k. It's a little bit different, but you can invest post-tax dollars and then you won't have to pay taxes on it in the future. The difference here, the main difference I can think of with a Roth IRA versus a Roth 401k is that what you put into the account, you can actually take out before 59 and a half. So if you put in, again, let's just make the numbers easy, $6,000 for 10 years and then you retire and you want some money, well, you can take out that $60,000 worth of contributions, money that you actually put in. You just can't take out the profits that you've made from it. So if your account grew from, instead of $60,000, which is how much you put in, let's say it went up to 120, well, you still could only take out the initial amount that you put in there. So this is another great account. If you're doing just a traditional IRA, you can invest pre-tax dollars. And then a brokerage account, this is basically got no tax benefits to it. You're basically just putting money in, and how this works is you're taxed on the front end from work. Let's say you made $100 and you're taxed 30%, you have $70 left. You put all that, let's say, in a stock or in the stock market, and then that money goes and you gain a lot of money on it. Let's say you go from $70 up to $100, and then you sell within a few months. You would have something called short-term capital gains, which means that you are paying, at this time at least, it's your tax bracket. So again, you go from 70 to 100, and then you have to pay taxes. You have to pay 30% tax on what you gain. So it's not bringing you back down to $70, but it's taking 30% of that $30 you made, which brings you back down to $91. So that is not great from a tax perspective, but some people just make too much money that they can't invest enough into the 401k or the HSA or the IRA, and they have to invest in brokerage accounts too. Think if you're making, if you want to invest $100,000 in the stock market and you're single, well, here's about $20,000 you can invest in the 401k, another $4,000 here, another $6,000 here, and you're left with about $70,000. So you have to put it in some other type of account. So if I was someone new to the stock market wondering where I should put money first, well, I would go with the 401k up until the match. So go and invest at least what that is. So let's say they invested, or they matched you 100% up to 5%, let's say, and you were making $80,000. Well, 5% of $80,000, you could put in about $4,000. They would also match $4,000. So I would do that first. Then I would go over to probably the IRA or the HSA. It's kind of a toss-up. It depends what you prefer. I would think the HSA is actually a little bit smarter to invest in next, because all of us will have some kind of health problem in the future or some kind of health thing that comes up, and it's got a lower limit compared to a lot of these other accounts. So I would max out the HSA next. So get the 401k match, then HSA. Then I would go over to the IRA, and I would invest up into the max there. And then after that, I would go back to the 401k. If you max that out, then I would go over to the brokerage account. Now, a lot of people just open brokerage accounts, especially like in college. There's someone that wants to try out the stock market. A lot of them go with the brokerage account. It would be smarter to do it in something like a Roth IRA if possible. And the nice thing about that is too, in these three types of accounts, if you sell your stocks, and then as long as you keep the money in there, there are no taxable events. If you sell in a brokerage account, let's say, again, you make a lot of money, you have to be taxed on it. You sell at a loss, you can claim some different tax incentives, but there's just a lot of taxable events if you're using a brokerage account as opposed to these other ones, then you don't have to worry about taxes as much. So I would do that. If you're wondering whether to do traditional or Roth, generally if you think that you're going to retire pretty soon, you're probably making a good amount of money, which means that it would probably be smarter to go with the traditional. But if you're someone that's just starting out and you think you're going to get paid more in the future, let's say you're making $30,000 or $40,000, $50,000 now, you think you're going to get paid more in the future, it would probably make more sense to go with the Roth. Another option is you can look at your income tax bracket. And generally, if you're in the 12% or down tax bracket, it probably makes sense to go with a Roth. If you're in the 22%, and especially if you're above that, it probably makes more sense to do traditional. So if you're making, as a single person, over $40,000 after you claim your deductions, it might make sense to go with the Roth, or the traditional. And if you're making under that, then probably the Roth makes the most sense. And again, there are some different tax deductions you get before this too, so just keep that in mind. So let me know if you have any questions about that underneath the video. Hopefully that helps anyone that's looking at accounts. Again, 401k match, HSA, IRA, back to the 401k, and then the normal brokerage account, which is what a lot of people invest in, not realizing that they could be getting tax-free dollars or tax incentivized dollars instead. So thanks, I appreciate it, and let's get into the next video. Okay, so now that we have a game plan on what kind of accounts to invest in, you might be wondering how you should invest. What kind of investment should you actually make? Because honestly, there are so many different ways that you can invest. Like, for example, you Google how to invest or where to invest in, or the best types of investments, and you get a lot of different things, right? High yield savings accounts, CDs, money market funds, government bonds, corporate bonds, mutual funds, index funds, ETFs, dividend stocks, and there are just so many different options. So we're just going to talk about them a little bit here and talk about diversification. So if you don't know what diversification is, it is having your money across a variety of different assets. So one way of doing this is through doing or investing in several different kinds of investments. So maybe you have some in high yield savings accounts, some in mutual funds, some in index funds, some in real estate. Now, the reason that diversification is so important is because no matter who you are, you can be wrong, right? You're not necessarily right. Even if you feel very high conviction about something, oftentimes there are things that you just don't know about. So if you're super excited and bullish about some cryptocurrency, tomorrow one of the biggest investors could decide that they need to go buy an expensive property, and then they sell, and then it causes other people to sell, and the whole market goes down. Or there could be some kind of major problem where we go through another pandemic or something like that. So even if you're super bullish on something, it usually makes sense to diversify. Now, some people have different thoughts and feelings about this, and it's going to depend on your age, how diversified you probably should be, and what kind of risk tolerance you have. If you're younger, you can usually afford to take more risk, but it doesn't mean that you should be stupid, because that is when, if you invest well, you can make the best returns on your assets because you're going to have them for a very long time. You have a very long investing time horizon. Some people, like Warren Buffett, says diversification is a protection against ignorance. It makes little sense if you know what you're doing. However, he is very diversified. So he runs Berkshire Hathaway. He's one of the wealthiest people in the world, nearly $1 billion, $100 billion net worth. And yet they hold a ton of different companies. Part of that's because their company itself is so large that it's hard for them to invest in one specific company. Part of it is because you actually make a good amount of money diversifying over time. Now, if you can wait to the perfect moment and you know that something's gonna make money, then maybe you take a larger bet. But like I said, oftentimes it's hard to know exactly the full picture, and it's all about taking calculated bets. So he has even said himself that if he were to pass away, or when he passes away, he just wants his money to go to index funds. So that's what he would instruct his family to do. So it is pretty difficult to invest really well in just a few different stocks or a few different cryptos. A lot of the time, when you hear about people becoming really rich, they have invested in just a few assets because they are the outliers. They were in on the stock that went up, 100x, or the crypto that went up 100x, and they had a significant amount of money in it. But you don't hear about all the other people that put in all their net worth into some crappy stock or some crappy cryptocurrency, and then they lost a lot of their money. So I usually think it does make sense to diversify. Also, it just makes you sleep better at night. If you have a fourth of your portfolio in crypto, a fourth in cash, a fourth in stocks, and a fourth in real estate, you sleep a little bit better. Now, cash, like I said there, 25% would be a little bit high. I think somewhere around 5 to 10% cash, depending on who you are, what kind of situation you're in, would make sense. Cash for investing. So that way you can actually buy the dip if there is some kind of significant dip in the markets. And it just, like I said, it makes you feel really confident sleeping at night. Now, my cash is a little bit higher. I'll say this in a little bit, but I'm around 20 to 25% cash, but a lot of it is working for me, which I'll talk about more later. How I diversify is I have cryptocurrency. So that is a significant part of my portfolio, probably about 25% or so. I have cash, I have cash in stablecoin, and I also have cash just in the bank. So there are a couple different ways you can do it. I like cash in stablecoins for the fact that you can actually get a yield on it, a nice amount of money. You can get companies to pay you every single month for keeping your stablecoin there. And you can use DeFi and a bunch of other things too, which we won't get too into. You can look that up on my channel and just see how to actually retire on stablecoin or how to make a significant amount of money on stablecoin. I also have money in real estate. So I do have about 20% cash right now, but I'm using it to dollar cost average into the market. I'm not just trying to sit on it. And some of that is because it pays a good amount in stablecoin. So it's just easy money just flowing to me every day or every month. And then also I have real estate. I own this house. I think having some money in real estate makes sense, especially if you can leverage it, especially with, let's say, a 30-year loan at a low interest rate, and you put 20% down. Let's say it appreciates 3% in 1 year. Well, let's say if the property's worth $103,000, just to make the math easy, right? It appreciated 3%. You only had to put 20% down, which is $20,000. So you actually got a return of 15%, even though it only went up 3% because you're leveraging your money. Now, I think that is a good investment. Of course, there are caveats, and we're going to talk about each of these asset classes more in depth here in a second. Also, I put money in the stock market. I have about 25 to 30% of my wealth in the stock market as well now. So there are a couple different ways you can do it. You can either invest in individual stocks or in index funds. So again, we're going to go through each of these separately, but here are kind of my thoughts on some of these different investment types. High yield savings accounts, as of now, barely pay anything. The only reason to keep your money, I think, in a savings account or a checking account is because you want some cash on hand, and it's not because you want some kind of yield. A lot of places will pay you less than 0.1% to keep your money there. So if you have $100, you get, 10 cents a year? If you have $100,000, you get $100, I believe, or something like that. So it's really not a significant amount of money. Certificates of deposit, I think, are even worse than savings accounts right now because you might get 1 or 2%. But the fact is, it's locked up over time. So a lot of people, I know, because I used to work at the bank, a lot of young people thought that this was really exciting. Like, they get a chunk of money from something, even if it's just a tax return, right? A few $1,000s or something. They'd go and they'd want to set up a certificate of deposit. And I was just shaking my head. Of course, I can't say not to put it in a CD, but the fact is, that does not pay you enough to make up for the fact that you have to lock it up. And a big part of that is because of inflation. If you don't know about inflation, it is the fact that we continue to print more and more money over time here in the US, and we have kind of a supply crunch right now too. So there's a lot of demand for products. There's a lot of money for products, which means that there's a lot of demand as well. And there just isn't the ability to make enough products. So the fact is, over time, everything becomes more expensive. I think we know this. Some things get less expensive, like technology, but food, housing, this kind of stuff gets more expensive as time goes on. So right now we're facing 8% inflation. Typically it's 2 to 3% inflation, but that means CDs and savings accounts, you're actually losing money when you think about it. Money market funds, this is another type of low interest deposit. I don't really use them at all. I don't use government bonds, corporate bonds. These oftentimes are put in retirement accounts. So a lot of people have bonds, especially older individuals. It makes sense to hold bonds a little bit more. That's basically an IOU on debt. But for younger individuals, it doesn't make too much sense to hold bonds because, again, these are negative yielding, real yield. Also, mutual funds, you have to be careful with these. We're going to talk about them here in a moment. But mutual funds are essentially a basket of different stocks and equities. But the problem with a lot of them is they charge you a significant amount of money. They might charge you 1 or 2% a year to put your money there, which doesn't sound like that big of a deal, especially over the last couple of years. We've had, 20% returns on a lot of mutual funds and index funds. But 1 or 2% can eat into your overall portfolio a lot over time. 1 to 2% a year. So if you have $1 million in there, it's charging you between $10,000 and $20,000 a year just to keep your money there. And when you compare that to something like index funds typically do even better. They're just a basket of different stocks. They don't have those excessive fees most of the time. So index funds are one of the best things to invest in. You can also invest in dividend stocks that actually take some of their cash and some of their cash flows and pay it out to investors. You can invest in those as well, individual dividend stocks. Now, some of these are there are different funds for them, so you can carry a variety of different dividend stocks, or even individual stocks you can invest in, let's say Tesla. You have to do a lot more research, and it's higher risk. There's also higher reward if you can pick it right, although it is very difficult to do. ETFs are another way to invest. Again, just a basket of different stocks typically. And then we also have alternative investments. So you could invest in playing cards, right? I have a Kobe Bryant rookie card behind me. You could buy those, try to make money in that, or fine art or wine, or cryptocurrencies. This really should be its own asset here. I don't know why they linked it in or put it together with these alternative investments. And then real estate as well. You can buy rental properties. You can buy your own home. I don't really think of my home as an investment, but it is an asset. So it's something that I could sell for money, but it's not making me any money. It is saving me money from having to go and rent somewhere else, but it's not something that is cash yielding. I'm not getting paid to own this property at all. I have to pay the government to stay here still through property taxes. So we're going to take a moment here and go through some of the specific types of assets that I own and what to look for in them, because there are some things that you want to look out for here. Okay, so now we have to take a look at index funds and how to invest in them. This is one of the favorites of a lot of investors out there. A lot of them just invest in index funds. Even people here on YouTube invest specifically in index funds, and that's because you get a lot of diversification. So only a few companies perform, let's say, extraordinarily well out of the top 500 companies in the world. Let's say they go up a couple 100%. Well, if you have an index fund, that will bring up the average of the index fund. If you have losers that go bankrupt, well, you didn't invest exclusively in them, so you won't lose all the money in those securities. So index funds and mutual funds both invest in a variety of different equities. However, mutual funds are usually actively chosen. They're actively chosen by individuals compared to index funds, which just track something like the S&P 500. So a couple good ones here. VOO, you can see it here. It's a Vanguard 500 index fund ETF. And then also something called VTI, which is the Total Stock Market Index Fund. So depending on how much diversification you want, you can either have just the top 500 companies. I believe VTI has more companies than that even. There are other funds too that aren't through Vanguard. Whatever you do, you want to look for something that has a low expense ratio. For example, some mutual funds have very high expense ratios, some 2, 3, 4%. Even some money managers, like working at JP Morgan, but Edward Jones or Raymond James, they might charge you 1% on top of these fees. So when you're looking over a long period, let's say you're 25 years old and you're going to be retiring at 60, you get 8% a year, right? At the end of that time period, you have $2.14 million. A huge amount, right? But what if you get only 7% because there's 1% fees? Let's say it's just a mutual fund with 1% fees. Some of the time they even put you in your retirement accounts just through your company. Well, now you have $1.7 million. That's a huge difference. That's $400,000 that you're losing out on. And most of the time, these different actively managed funds don't even beat out the indexes. Like the S&P 500 typically beats a significant amount of actively managed funds out there. Now, of course, there will always be funds that outpace the index funds, because the fact is they have thousands of these different mutual funds out there. So just chances are that someone's going to pick something that does better, but typically they can't continuously do better than the index funds. Even if you look at something like ARK Invest. ARK Invest did really well over the last couple of years. This year, it did worse. So a lot of people just go with index funds and just only invest in index funds, or that's the majority of their portfolio. Whatever you pick though, you want to make sure that if you're picking a basket of stocks and you're picking some kind of ETF or index fund, that you're buying something that has that low expense ratio. Should be really easy to just Google, or if you look at some of the document papers about the funds, a lot of the time they will give that percentage. And you want something very low. Typically, you want something under 0.1%, like I believe the VOO fund is around 0.03 or 0.04. Those are pretty acceptable. Some are actually completely free. So just make sure that you're investing in something like that. Now there are a variety of places that you can invest on, and that's something to consider too. You can invest in a lot of different brokerage accounts. I would just invest in one that's easy to use for you. I use Fidelity. I also use M1 Finance. I use Webull. I use Moomoo. There are a bunch of different options out there for places that you can invest in, but just make sure that it's somewhere that you like and that doesn't cost you any fees to trade. Some companies still do that. I don't think you really need to pay for trades here in America anymore. It's just something, of course, throughout the world, you might have different transaction fees, but I would not be paying for any kinds of trades. Now we've talked about how to invest in index funds and why they are much better than mutual funds, but some people want to invest in individual stocks. I invest in individual stocks. Now what you need to know going into this is there is more opportunity, there's more upside potential in individual stock investing. However, there's also more downside potential. You're essentially taking a bigger bet on yourself than just investing in an index fund. Now, for some people, this makes a lot of sense. If you can invest in a company that's going to vastly outperform the market and you have a significant amount of money in there, you can become very wealthy, wealthier than you would have otherwise through index investing. Now, for people that have less money, like let's say you have $5,000 or less, I think figuring out how to increase your income is more important. I talked about that earlier in the video, but if you're trying to spend 10 hours a week, 20 hours a week, figuring out how to invest in individual stocks, that's probably going to be great down the line. But if you have $100 or $200 in there, it doesn't really make a difference. 2% difference on $100 is $2. You could probably find a job that would pay you much more than that and you'd make a lot more money. Now, let's say you don't want to go with VOO. You want to invest in individual stocks. So these are a couple things I look for. Let's just take a look at Amazon overall. First of all, you need to know that this can fluctuate wildly. Any of these stocks can, more than the index funds. They don't get smoothed out in bad times and good times. There are antitrust issues with a lot of big tech where a lot of people get fearful. Large investors can sell one stock specifically and drop the price pretty drastically. Amazon fell 90% after 2000. And you had to stomach through that. A lot of people said, oh man, I would have loved to invest then. But you have to realize that's when people think the company is going bankrupt and your investment's going to be worth nothing. That's why it was discounted so much. But if you can get through that, you can make a lot of money. So here are a couple good things that I look for. First of all, does the company actually have a good product? And in 2021, there were certain times where the companies didn't even have a product. They were just working with IP, intellectual property. They were trying to build to a product. And that was okay in 2020 or 2021 when there's a crazy mania phase in the stock market. But as time goes on, everyone comes back to valuation and the company fundamentals. So do they actually have a good product? Is it something that I use? Typically, if it's something that is really easy to use and maybe you can see your friends using it, typically that means that they are a market leader. All right, everyone that you know probably uses Amazon. They use Amazon Prime. There are a bunch of different parts of their business that are great products, whether it's Amazon Web Services, whether it's the retail business, whether it's advertising, whether it's Amazon Prime Video. They have a deep moat. They have a very large moat. There's no one else that can compete with Amazon. Other companies try to, but really they have a monopoly. And a lot of us think of monopolies as negative things. Like if you're a consumer, a monopoly is a negative thing because you think, okay, Amazon could easily raise prices and everyone else has already died out, so they could just raise prices. That's the main theory why monopolies are bad, just because they can control the market and what people pay. But when you're an investor, monopolies are very good. And I'm covering all this pretty quickly. There's a lot more that goes into individual stock picking, but these are some of my main thoughts. Monopolies are great if you're an investor because no one else can compete. You continue to grow, you continue to gain market size and new users. You can actually make money from them in different ways. And there are a lot of ways to grow when you're a monopoly. You control the market, and it's easy to get discounts if you're trying to absorb other companies because they just can't compete. You can get discounts on buying them if you want to even. So a lot of people look for monopolies. And these companies, Amazon, Google, Facebook, Apple, they won't say that they have a monopoly. They're always trying to say that they don't. It's better that they have a monopoly and say that they don't because they're not trying to really attract new investors. They're trying to grow their business. They don't give a crap if you invest in them because they're so large already and have such a dominant position. What they're trying to do is make sure that they don't get broken up by the government, right? So if they say that they don't have a monopoly, they don't control the market. There's so many competitors out there. They're just trying to make sure that they can continue doing business. That's a good sign that they're probably pretty large and control the market. It's all the small companies that say that they're pretty much the only one in the space. No one else can compete. They control the market. Those are the companies that are not monopolies. Those are the companies that are vying just to get capital in so that way they can probably dilute shareholders, which means that they would give out more shares. They could try to raise some capital to put in different places. Those are the companies you have to be careful of. So we need to have a good product, something that will actually grow over time because otherwise you're investing in nothing, nothing worthwhile at least. They have to have a large moat and a monopoly. You want to give them at an attractive value. Now, one way to do this is to look at their historical price to earnings ratio. Price to earnings is just the price of the company, the overall market cap divided by the earnings of the company, how much they actually make after all expenses. You can see Amazon's here. It's kind of thrown off because of this year, but you can see 540, 170, 175, and now it's around 50. Now, the reason it's getting lower and lower is because it's getting larger and larger. The growth isn't as quick, or the revenue growth isn't as large as companies typically move on and progress. If you're something like Amazon, it's much harder to grow from, let's say, $100 billion worth of revenue to $200 billion compared to $1,000 to $2,000, right? That can happen overnight, but they're not growing another $100 billion worth of revenue in a day. So that's why, as time goes on, companies typically become less and less expensive. And that's something that you can see, but there's always fluctuation, right? If we look over the last 1 year, Amazon fluctuates in price, in value. So you want to get it at somewhat of a historical low, or at least a recent low. You don't want to be buying a company when it's really highly valued compared to historical context. Now, sometimes it's still a good time to invest in these types of companies. Let's say they have some new giant revenue grower, or they became highly profitable all of a sudden from some new part of their business. Then it might make sense to buy them when they're a little bit more expensive, or they have a huge growth driver in front of them. But typically you want to get them at a good value. Also, you want good growth. So you can look up the company's financials. You can see, okay, revenue has grown, and this is just on the 1 year here, from 232 billion to 280, 360, 386, 469, and you can see significant growth, right? That's an $80 billion growth, which is 20% year over year. Also, they're pretty profitable. When you look at this, they have $200 billion worth of gross profit. So they have good growth. They're continuing to grow their profit. They're continuing to grow their net income after all expenses and everything, R&D, and they're becoming pretty profitable here. And right now, too, they're spending a lot of money on things that don't really matter too much. So research and development, they're spending $56 billion a year. And if you go through some of their different divisions, like their moonshot divisions, some parts of their company that are really futuristic that they don't necessarily have to spend money on, that's probably half of the research and development. So $20 to $30 billion. If they just cut those, they decide, okay, we just want to become profitable, they could double their net income overnight. Maybe after a month, but you can see what I'm saying here. So yes, they're trading at 50 PE, but if they start cutting out a lot of the fat, it could be a 25 PE very quickly. So you want attractive value, you want good growth, you also want a good balance sheet. So what does a good balance sheet actually mean? Well, we can take a look at some companies, and some companies have a better balance sheet than others. Let's just take a look at Amazon just to keep it going with Amazon. $96 billion worth of cash and short-term investments. Now, short-term investments could be bonds, something like that, some kind of treasuries that aren't necessarily just cash sitting in the bank. They have some receivables, some current assets. You can see some is inventory, so products in their warehouses. And you can see the property and equipment, $216 billion worth of that. So total assets are $420 billion. Okay, total current liabilities, $142 billion. So this is a huge amount of debt, right? $142 billion. But they have $96 billion in cash. And when you look down here, we can see accounts payable, $78 billion, accrued expenses, $28 billion, short-term borrowings, less than $1 billion, current portion of long-term debt, just over $1 billion, unearned revenue current, and then other current liabilities. So they have a significant amount. However, they're a cash flow machine. They could pay this off. Typically, this is the current liabilities are what's due in a year. And the fact is, they could get more cash if they want to. They could stop investing so much in their business. They're not really sitting in a bad situation. Some companies, though, are sitting in even better situations. Let's look at Meta. Meta has a very good balance sheet. When we look at them, It's probably even stronger. So cash and total investments, $48 billion. Let's take a look at their total current liabilities, $21 billion. So they have a current ratio, which is the cash divided by the current liabilities, of about 2. So they could pay off all their debt, still have $20 billion in the bank. Some companies have even more than that. Let's look at Berkshire Hathaway. So Berkshire Hathaway is Warren Buffett's company. You can see $147 billion in cash. They're just sitting on so much cash. And then total current liabilities, $51 billion. So a lot of that's accounts payable, but you can see they have basically a 3 current ratio. Other companies have even higher than that. So you can see you want a good cash position. Otherwise, you can see that they're going to have to either raise debt or sell shares of their company, therefore giving you less earnings per share because there are going to be more shares outstanding. So these are a couple of the things that you should watch for. Some different metrics you can look at are the price to earnings ratio, which is basically, again, how much the whole company is worth divided by their actual earnings. So that gives you an idea for how expensive they are. Usually they range from 10 to 100, depending on what kind of company and how quickly they're growing. If you're looking at banks, 10 is pretty normal. If you're looking at a high growth, high margin business, then you're looking at maybe 50 to 100, maybe even more than that. Some sell it much higher than that. Some companies are unprofitable completely, but you think that they're going to become highly profitable once they scale enough. Another thing you can take a look at is price to sales, which is basically their total revenue or their price, so the total cost of the company divided by their total revenue. So with some higher growth companies, a lot of people look at that instead of the profitability because they might not be profitable at all. So those are just a couple things to look at for stocks. And when I invest in individual stocks, I used to take a lot of different bets. I used to buy into 30 to 50 different stocks. The hard part about that is it's really hard to keep up with the companies. It's really hard to follow 50 different companies and figure out what they're doing, their future growth, and even if you're right on some of them, it doesn't move your portfolio that much. Let's say you do a 3x on a stock and you have 50 stocks at 2% each. You do a 3x, that means that you got a 4% total return from that stock. It's not really that big of a return. Now, if you invest in a few companies, there's much higher risk. That is what I do now. I invest in some of the top tech companies like Amazon, like Tesla, Google, Facebook. Then I have a few smaller companies. I like that a little bit more because it's much easier to follow. And a lot of these companies are highly diversified, like Amazon. Amazon, we talked about already, but they have all those different metrics that I like. They also have significant amount of parts of their business that bring in cash flow and that are pretty expensive businesses if they were to be split up. For example, they have the retail business, their shipping business, Amazon Prime, all that. Or I should just say they have their Amazon retail business, like all the shipping, their 2-day shipping. They have their advertising business, so they actually make a really significant amount of profit just from advertising different products in different places. Companies pay for that. Both of those parts of their company are worth a good amount. They have their Prime business, which includes 2-day shipping and that stuff, but also they have their Prime Video business. So that brings in a significant amount of money. Now they're actually losing money overall, I believe, on that right now, their Amazon Video, because they are putting so much into content. It's a loss leader. They're willing to lose money now to get people to use all their ecosystem. They also have Amazon Web Services, which is their cloud business, which is high margin. And they're pretty well diversified throughout all these different parts of their business. They also have a bunch of other parts of their business that are growing that you just don't even hear about. A lot of them moonshot companies. Google has a lot of companies under its belt. Facebook has a lot of social media. These companies pretty much control the world. So I'm okay investing in a few of them. It's easier to follow them. They have great numbers, high profitability, great balance sheets. And really the only main fear between a lot of these different investors is, are they overvalued? And then also, will they be broken up by antitrust laws and the government? So I don't see that as a massive problem because you don't want to stifle these companies. These are the companies that are growing like crazy and creating a ton of innovation in your countries. So I think the government's a little bit cautious about doing that. Again, they're saying they're not monopolies. So there's always a battle over that. But then also when you look at whether they're too expensive, again, like we said, Amazon could be a 25 price to earnings ratio, or maybe a 30 price to earnings ratio if they really want to be. They cut out a lot of the fat. They could be highly profitable, and they're growing like a weed. So that is why I like these companies. Let me know your thoughts on this underneath the video though. And this is a bigger topic, right? You can't look at all kinds of individual stock investing in 15 minutes. That's this segment. But I think this gives you a good idea for what I look for. Of course, there are a bunch of different ways to invest. You could look at technical indicators. You could be a day trader. You could be a dividend investor. And there are different reasons to do different things. A lot of day traders aren't successful for a very long time or ever successful. Dividend investing can be interesting too, but I focus on this high growth investing. Now let's talk about the next part of the video, which is high growth also. And it's something that I talk about a lot on this channel, which is crypto. Crypto. I talk about crypto so much on the channel. I'm not gonna spend a ton of time on this just because if you wanna follow crypto, you can do it really easily by hitting the subscribe button and watching more of my videos. I talk about crypto all the time, and I talk about the cryptos that I'm buying. Now, first of all, you do have to know where to buy crypto. I do have a couple links underneath the video. These are some of the places that I hold crypto. FTX, they have no trading fees, and you get free crypto on every trade over $10. I hold some crypto on Voyager. There they actually pay an interest rate on your crypto. You can earn rewards. BlockFi does something similar for people outside of the US. Inside the US, you get a bonus up to $250. All of these places are great places to hold crypto, in my opinion. These are all on exchanges. You hold it on an exchange. You can also hold it on a hot wallet, something like Trust Wallet. This is more decentralized, so there's less of a risk of something, there's less of a risk of your crypto ever being taken away from you in case there's some kind of government regulation or some kind of freeze of assets. However, you get less rewards, and it's a little bit more in depth what you have to do to buy cryptos, and some of the different transactions are a little bit more difficult. Then you can also hold them on cold storage, which is what a lot of people want to do when they say not your keys, not your wallet. Basically, you can put it on some kind of storage device, and that way it's really taken off, so it's in your control. But you have to realize if there's some kind of a flood or a fire, or your significant other throws it out, or you forget some of the seed phrase to get into the crypto, you can lose a lot of it. So you have to be careful. You have to realize what you're good at. If you're not good at password protection or keeping things in order, holding it on cold storage is probably going to be really difficult and could make you lose your crypto over time. Now, I hold the majority of mine kind of on exchanges, spread across a variety of exchanges because I do like the rewards, and I'm okay with the risks that it comes with. Now, what should you buy? Now, this is going to be dependent on you specifically. What are your goals, right? Do you want to become financially independent? Do you want to possibly become a 10 millionaire and you're willing to take a high amount of risk? It's going to be dependent on you and what do you understand, right? Do you understand inflation? Do you understand gaming? Do you understand art and NFTs? There are a lot of different ways that you can get interested in crypto, or a lot of different areas that you can invest in crypto. I would suggest, personally, at least if you're starting off, staying with some of the top cryptos here. Some of them are stablecoins, and I talked about stablecoins a little bit earlier in the video. This, I think, is a good way to earn some extra yield and have cash on the sidelines. I don't like USDT. There's some scandals about whether they actually, whether they're legitimate or not, and whether they have something to back the USDT, I mean. And then I do like USDC. I like UST. It's down here as well. But going back to the cryptos, I think you can't go wrong with some of the big cryptos out there. Now, if you're hoping for 100x returns in the next 5 years from Bitcoin, that's probably not going to happen. But I think it still offers a good risk to reward ratio. Now, some people look at the price of these different cryptos and think, okay, Bitcoin's really expensive, Ethereum's less expensive, than everything else just goes down the line. And if something costs $1.14 it must be much cheaper than something like Solana, which is $102. And I think that's because we're used to seeing prices like out and about. You see everything denominated in the US dollar, and if someone's selling you this pen for $1 and someone's selling you these AirPods for $160, you know that the pen is $160 or 160 times less expensive. That's not the case with cryptos or with stocks. You have to realize that they can be split into as many parts as they want, right? So Solana has less shares, or less, I should say, less crypto or less different tokens than Cardano. Cardano split a lot more. They're about the same size. Actually, Cardano is actually a little bit bigger, even though the price is 1/100th as expensive. So there are just more Cardano or more ADA tokens out there. So first of all, if you haven't already figured that out, or if you don't know how market caps work, you should look into that a little bit deeper. You have to look at the market cap. Now from there, you can stick to the top 10 to start. I think you should figure out what the crypto is. From there, I think you should figure out what value principles or what value statements these cryptos provide and whether they make sense to you. I hold Bitcoin because it is not inflatable like the US dollar. It's anti-seizure resistant. It has a trajectory that is very easy to follow because there is a set supply. And you can see adoption happening all the time. More and more people buy it. And it's going to become less and less inflationary over time. It's easily transactable, can cross the world in split second. And there are 100 other reasons. I actually have a full video that was, I think, about 40 minutes. It was 50 reasons why you would like Bitcoin. And I'm sure I only covered a tenth of the different reasons out there, but there are a lot of different reasons to hold Bitcoin. There are a lot of different reasons to hold Ethereum. Bitcoin is really in a class of its own. Ethereum is kind of in a class of its own. It's a layer 1, which means things can be built on top of it, different applications, but it is the largest of the altcoins. A lot of other altcoins, though, are trying to get into this number 2 spot and trying to take Ethereum's throne. Now, I think staying diversified in different cryptos makes sense too. And just to go through the top 10, I'm a big fan of Bitcoin. That is my largest holding of any asset besides my house. Ethereum, I think, is a great asset to hold on to too. I have less of it than Bitcoin, but I still hold on to it. BNB, I like. It's not something that many people talk about, but it's the crypto of the largest exchange out there. I don't like XRP. I have some Cardano. It's not my favorite layer 1 out there, but it has a very strong community. Solana, I love. That's my third largest crypto. Luna, I really like too. I like AVAX, and then we won't get into the other ones. But I would stick to some of these. If someone promises you 100x gains, that's not going to happen. For a lot of cryptos, there's a lot of risk when you get outside of the top 10, top 50, top 100. And the further down you go, the more risk there is. You could still make a ton of money, but also it could pump up, you could get really excited, and then someone could sell right when you're buying in. So you have to be careful. Make sure you're okay with holding these for the next 3 to 5 years, in my opinion. You don't need the money, you just want to invest it, and make sure that you're comfortable with what you invest in and how much you invest in it. So just be careful. I think crypto has a lot of potential. I won't go too much more into it just because I talk about it all the time on my channel. You can subscribe if you want more of it, but I think it has so much potential, and it is a highly risky asset class. But when you look at the risk versus the reward, it should be a good long-term investment. All right, so let's talk about real estate. Now, there are 2 different ways to think about real estate. One is from the actual living in it perspective, and then one is for investing. We're going to talk about living in real estate first, and then we're going to talk about investing and why someone might want to do that and how to do it. So a lot of people think that if you're renting, you're just throwing away your money. And that's not necessarily the case. There are a couple of reasons why you might actually want to rent instead of own. First of all, is renting really inexpensive in your area? Now, for most of us, it's kind of a toss-up, but if you're living in an area where rent is let's say $1,000 a month and buying is $300,000 or $400,000, it probably makes more sense to rent. There's some places like this, but let's not take an extreme example. Let's say your monthly rent is $1,000 a month. That might seem like a lot. That might seem like not a lot. So it just depends on your area. But $1,000 a month, your home price would be $250,000. Let's say you could put in a down payment of 20%. Usually you want 20% because otherwise you have something known as private mortgage insurance. It's basically like an extra cost for the bank having a higher risk because you haven't put as much equity into it. So I would try to get to that 20%. But you can try to live in it with less. Also, if you're trying to get like a duplex or something, live in one side and then rent out the other, usually it still works out pretty well if you put in less than that. Let's say your annual income is $40,000, your spouse's is $40,000 as well. You have some homeowner's insurance, you have maintenance costs, that's maybe $2,500 a year. There's always stuff that's happening in the house. Even if you don't have anything for a full year, well, a lot of stuff is still being worn down, like your roof, your furnace, your air conditioner, stuff like that. You're gonna have to replace that at some point. Your house, let's say, increases 2% a year. That might seem like a little bit low right now, but we're just gonna say 2%. And let's say your rent increases 3% a year. So every year that you live in it, it goes from $1,000 to $1,030 to 30% higher than that, which is not another $30, but basically $1,061 or something like that. So it keeps on increasing. Well, if you were going to stay there for less than 8 years, it would make sense to actually rent. If you were going to stay there for more than 8 years, based on these numbers, it would make more sense to buy. Now, why would it make more sense to rent, right? Because you're not buying anything and getting equity. Well, there are a couple of reasons why it actually makes more sense to rent. First of all, you don't have to pay these closing costs. So when you buy a house, you have to pay a couple $1,000s usually to close on the loan. The bank gets some money and it's distributed through a lot of different places, but you might have to pay $2,000, so it takes some time to recoup that. Also, you have things like property taxes, like homeowners insurance, maybe HOA fees, maintenance costs. So you don't have those with rentals. Usually that's all taken care of for you. The fact is, property taxes, I don't even think are listed on here. I couldn't find anything for property taxes, and those are a significant amount. Mine are about 2% of my home's value each year. So on a $250,000 home, $5,000 a year, that's almost $500 a month. And that is not something that gives me any value. That's just the cost of living here on my own property. So that is money that's thrown away. Some people think that rent is thrown away, but you start looking at these and you're thinking, okay, $500 a month to property taxes, or $400, a couple $100 a month to just maintenance costs, a couple of $1,000s a month to close on the home. If you're gonna move somewhere, it makes more sense to rent in the short term, even if it's 3, 4, 5, 6 years. Also, you have the opportunity cost. If someone offers you a job for $20,000 more in a place an hour away, maybe you don't want to commute. Maybe you want to move there. Well, if you have a house, then you have to sell. If you sell, you have rent, you have agent fees. So unless you sell it yourself, which is very unlikely, on a $250,000 home, you're probably paying 6%. So you're looking at another $15,000 worth of fees there just from the realtors. So just because you need somewhere to live doesn't mean that you should always go buy. And that's just one example. It might be different in your area. It definitely is different in your area, what the rent is and what the home prices are. Now, what if you're investing? Well, there are a couple reasons that people actually like real estate for investing. And this is a shorter version, obviously, than what you could get on YouTube if you were looking really in depth. But there are a couple different reasons why. High cash yield. You can buy real estate and you can get paid monthly. If all your expenses are taken care of, then you can actually get more money on top of that. You could get $100, $200 a door. Also, equity buildup. There are a couple different ways that you can get this. So equity is ownership in the building. One way is mortgage pay down. As time goes on, let's say you have a mortgage, you have a 30-year fixed rate mortgage on the property, and someone is paying that for you because they're paying you rent. Well, as time goes on, you eventually will pay off that mortgage. So after 30 years, you won't have a mortgage anymore. You'll own the entire property. So as each year goes on, you get to pay down the mortgage. So you own more and more of the real estate. Also, you have appreciation. So as time goes on, the value of the property goes up, and that goes straight to you. The bank doesn't get any part of that. Also, you can take leverage. So you don't have to put down the entire value of the home to be able to get that home. With stocks and bonds and cash savings, it varies. You can go on leverage for stocks, but not really bonds or cash savings. Now, leverage is great too because if you have appreciation, you can make a lot of money from it. So let's say you have a $100,000 house, you put down 20%, just to make the math easy. you put down $20,000. Let's say it appreciates 5%. Well, now you have a $105,000 house and you got $5,000 worth of appreciation. That's not a 5% gain for you on your investment. You only put in $20,000. None of the $5,000 is going to the bank, even though they hold 80% of the home value on their mortgage. You actually get all of that. So you actually got a 25% gain. Your equity went from $20,000 to $25,000. Plus you paid down the mortgage in that time too. It's also a hard asset. It actually is tangible. People will always need places to live. And then it is tax advantage. You can do a variety of different things. There are a variety of tax write-offs, so that way you are incentivized. The government wants to incentivize people to buy real estate. That's just the fact. And then how would you invest in it? Well, there are a couple different ways to do it. When you look for real estate, a lot of people use the 1% rule. You want to be able to get 1% of your rent each month, or 1% of the home's value each month in rent. So if you have a $200,000 home, you want to get $2,000 worth of rent each month. Now that's just a general rule of thumb. A lot of places don't have that. Like if you live in California and you buy $1 million house, you're not going to get $10,000 in rent each month, most likely. But if you can't do that, a lot of people try to go with the BRRRR method. They buy, rehab, rent, refinance, and repeat. So you buy the house, put 20% down, rehab it. So let's say you buy it for $300,000. You put in $50,000, but now it's worth $400,000. So you built in some equity. You built in $50,000 worth of equity. Then you rent it. You rent out the property to start getting cash flow. You refinance it, so you only want 20% in that $400,000 property. Okay, well now you get a mortgage for $80,000. You had a mortgage for $60,000 originally when you put the 20% down, but now you get a mortgage for $80,000 and you take some of the cash out that you put into it. You get some of that back. So a lot of the time you can do this, and if you can increase the value enough, you can get all your initial investment back. You refinance it, and then you repeat this. You take that money that you got back from the refinance and you go put it in another property. This is a way that a lot of people that want to put in some effort, a good amount of effort, and increase the value, they can get their initial investment back, continue to roll this into new properties. A lot of people think about house flipping too. House flipping is difficult. There are a lot of moving parts, and because there are so many transaction fees, you really have to be able to increase the value of the home a good amount. I mean, we talked about those realtor fees. That can really eat into your profit. Also, a lot of people go over budget. It is very active, and every day that you're not renting it out or selling it, you're incurring costs because of property taxes, electricity, that kind of thing. So you have to pay attention to that. This is really a full-time job, and a lot of people try it and aren't very good at it. But I do know some people that have done it successfully. And then hard money lending. So hard money lending is another way that you can invest. It's something that I've done before. Essentially, someone wants to go and they want to do a flip. They want to invest and flip a property. And hard money lending gives them the money to do that. So they don't have the money to come up with. You take, let's say, $50,000 and you loan it to them. Maybe you charge them 10%. So over the next 6 months, you charge them 10%, which is actually more than 10% a year. But let's just say you charge it for the next 6 months, you get a 10% return. That's great. It only took 6 months' time. And if they can't give you that 10% along with your original investment, so they can't give you that $55,000, well, you take over the home. So they might put up some collateral. They might put in $10,000 or $20,000 into the house. You put in 50, and then you're expecting 55 back. And if they don't actually give you that money back, then you get to take their $10,000 or $20,000 worth of equity from the house. That's just one example, but there are a bunch of different ways to do it. So those are some of the reasons that people like rental properties. Those are some of the reasons that people like to own real estate. But of course, every situation is different. It might be different for you. There are opportunity costs with owning real estate. There's time commitment, but a lot of people have become very, very wealthy. You can typically get a better rate of return than in an index fund if you do rental real estate right. And a lot of people get 12 to 15% rates of return as opposed to 10% in index funds. And it is more active. So that's something you have to pay attention to, but that means that a lot of people don't want to do it too. So there is more of an arbitrage opportunity. Also, everyone in the world can look at any stock essentially, but very few people invest in real estate that are in different areas. So there is an arbitrage opportunity there. And a lot of the time people just put up houses for the wrong prices, or they don't see the potential. Someone sees a way to rehab the house and add a lot of value, or there are new areas that are always gaining more and more people, and then they appreciate faster. So there are a lot of arbitrage opportunities, and the rental market and the housing market is still very segmented compared to something like stocks or crypto. So that's one reason that a lot of people like it. Now let's talk about having cash and how much you should have, where you should put it, why people would want it, that kind of thing. Now, there are a handful of different reasons to have cash. One, it just feels psychologically good to have some cash on the sidelines, some cash in the bank account. It's nice just for ease of use too, if you have another $1,000 or $2,000 in the bank, just so that way you don't have to worry about making payments and then transferring money in and out and stuff like that. Just nice for that reason to have a small amount. Now, outside of the operating cash that you might need on a weekly or bi-weekly basis, people have extra cash for a variety of reasons. One, probably the most common, is an emergency fund. People like to have anywhere between a month and up to a year's worth of expenses. Typically, it's 3 to 6 months worth of expenses in there, just in case they lose their job or the car breaks down. They have some cash to access so they don't have to sell assets. A lot of people keep that money in their bank accounts or in a savings account. Now, other people like to have extra money to buy the dip. Now, this is when you buy assets. If there's some kind of a dip in the asset price, let's say Bitcoin goes from 45,000 down to 30,000 and you want to buy, well, it is nice to have some extra cash just in case you want to deploy more at that time. Now, there are opposing theories on whether this makes sense or whether it's better just to put all your money into the market. But that is another reason some people keep cash on the sidelines. Then also some people just like it for an opportunity fund. So if some kind of investment comes up or some new business idea comes in or a piece of rental real estate comes up, that way they have extra money just sitting there just in case. Now this is probably the least normal thing for people to have. A lot of people like to keep money for buying the dip and emergency funds. Now the problem with all this, you have to be careful, is that it can really eat away at your returns. So let's say you invest for 35 years, you get a 10% rate of return. We're going to say this is before inflation because your cash is going to erode away to inflation in your bank account. So you get 10% a year, you put in $1,000 a month. So after about 35 years, you have about $3.4 million. So that's fantastic. But what if you had $10,000 this whole time sitting in your checking account as kind of an emergency fund and you could have invested it? Now, this gives you about $3.68 million. So you lose out on about $380,000. Now, you can't always get it right? Sometimes, like I said, it's nice to have a few extra $1,000, but some people take this more extreme. Some people want a year's worth of expenses. Let's say they put in $100,000 in there. Well, now instead of 3.4 million, you would have about 6.2 million. So you lose out on about half your entire investment. So you can lose out on a lot if you don't play this right. So how much do you actually have? Well, I think it's dependent on what you want. One thing that I like to do is I like to put my cash in assets that are actually working for me. So a couple different places I put some cash for buying the dip opportunities is in crypto. This isn't going to be right for everyone, right? This is higher risk than putting it in the bank. And a lot of people would say this is too high risk. Some people say that this is a great idea. I use BlockFi for one of the places I put my cash. There's a link to this underneath the video in case you want to sign up. They did change around how they give interest, but when I started, they gave up to 9% interest on stablecoin. So if you don't know what stablecoin is, you can do some research, but it's basically just pegged to the US dollar. Then BlockFi gets that money. They go and loan it out to other institutions. They have them collateralized, so they have to put something up as collateral. And that way, if they don't fulfill the loan, then BlockFi gets that in return, their collateral. So they pay me up to 9%. Now, this has changed a little bit recently with some regulations, but they still pay me about 7%. Another great way to do this is through Anchor Protocol. Right now, they pay 19.5%. They plan on decreasing this in the future, but this is one of the safest places to get about 20% interest in stablecoin or in DeFi. And this is using another stablecoin called USD. This is the stablecoin of the Terra ecosystem. It pays 19.5%, like I said, a really significant amount. And it is going to be backed, actually, USD is going to be backed with Bitcoin. So this is an interesting project too. I really like it and have a significant amount of money in here. But let's say you don't have a significant amount of money and you don't want to hold an opportunity fund or an emergency fund. Another thing you can do is you can have this springy debt. So this is from Mr. Money Mustache. He says he likes to use springy debt. That is debt that you can pay off or withdraw from at will. So he talks about how it doesn't really make sense. And I couldn't find the exact article, but I remember him talking about how credit cards can actually be better than an emergency fund. And that sounds crazy. It sounds just absolutely nuts to think about. But if you have enough money coming in that you can pay off the credit card in a month, let's say your credit card's at 24% a year. So each month that you don't pay it off, it's about 2%. Let's say you have something come up and you can pay for it in the next 2 months. So you have that 1 month of interest. Okay, so let's say the expense is $10,000. You have 2% fees, that's $200. Okay, let's say that happens twice a year, 3 times a year. Okay, that's $400 to $600 that it would cost you. Well, you're still getting 10% in the stock market on average. So making that decision and actually having a credit card, going into credit card debt short term would cost $400 to $600, and you would get $1,000 in the stock market. So even in an extreme scenario, assuming that you can pay off that credit card debt, and I'm not saying to go into credit card debt, but mathematically, it makes sense if your income's high enough and the expense is low enough. But a better way of doing that, because that's kind of extreme, a better way of doing it is having something like a home equity line of credit. There you get anywhere between 4 and 6% interest typically, and that's throughout the whole year. So maybe 1/4 the expense of a credit card, and you can just take that debt out, then pay it right back in a month or two, and it's not as risky. So that's another way of having the springy debt. So that way you don't have to have a large amount of money on the sidelines. Now let's say you want to keep some cash on the sidelines. How much should you keep? Well, an emergency fund depends how you want to do it. Again, if you want that springy debt, I think just having enough money to cover maybe a month or two of expenses, just so that way it's easier. You're not worried about bills coming through or anything like that. I think that makes sense. If you're being more conservative, people do go with that 3 to 6 months. I don't really like that too much, but I do have a significant amount of money to buy the dip. I just keep on also dollar cost averaging too. So I have money in my accounts that I just constantly flood into the market. Part of that is because my income changes so much. It's not like I'm getting a set amount every 2 weeks that I can plan on. So I have some more money sitting on the sidelines. Also, that's something to consider if you do have a very variable income, that you probably should keep some more just because you don't know when things are going to go really well or go really poorly. So I have money sitting on the sidelines to buy the dip, but mostly just to dollar cost average into the market. This money that I have in Anchor and BlockFi is really like buy the dip money, and I get a significant amount of yield on it. And then I do have the money that is just sitting there to dollar cost averaging into the market. So let me know your thoughts on this underneath the video. How much do you think you should hold? But let's move on to the next section. So now we've covered so much about investing, but this is possibly the most important thing for you to know. And that's your mentality behind investing. How you can outperform the vast majority of people and make yourself happy in the end, because that's really what it's all about. We started this journey because we want to become financially independent. We want to become able to do whatever we want, whenever we want, however we want for the most part. And a lot of people don't understand how important the mentality behind investing is. You're going to have so many emotions. You're going to figure out stuff about yourself that you've never known before. Warren Buffett says the stock market is a device for transferring money from the impatient to the patient. So when you're investing and you're buying stocks like Google or Amazon, and they're not as exciting as maybe some new tech, growth stock, penny stock, whatever it is, or you're buying Bitcoin instead of some small altcoin that is 5xing this week, just know that people are very impatient, but they will start to pay, or the people that are patient will be able to capitalize on that character trait over the long term. It's exponential. So if you put in $100, you get 10%. Okay, you get $10. A lot of people don't care about that. That's not important to them. But the next year you get $11, and then 12, 13, 14, 15, 16, 17, and you keep on getting more and more as time goes on. One thing that I like to do to get my mentality in the right spot is to dollar cost average. I talked about this earlier in the video, but to divide up my buys into smaller buys. The reason for that is because if you put all your money in, it could be great. You could have the investment skyrocket in price, or it could fall down pretty drastically in price. And the key for me is to stay invested over the long term. So to do that, a lot of it just comes down to mentality. Is my mentality in the right spot? And dollar cost averaging makes me feel less at risk to some kind of market conditions. And it's better just to put in your money in the majority of situations all at one time. That's shown to actually work most of the time because the market generally trends up. But a big part of it is how you can mentally handle the investments that you're being put in and that you're making. And a big part of that for me is dollar cost averaging. I just feel much more comfortable doing that. If I have, let's say, $10,000 to invest, I like to cut it up into a couple weeks, and it can change depending on how often you want to do it. It's all on you how often you want to DCA. But I think that this has helped me stay invested and feel good when the stock market falls down because I do have more cash that I'm going to put into the market. It can also lead to FOMO if the market goes up, which is actually what's happening at the time of this recording. The stock market and crypto market can also make you feel like you should just throw in a bunch of money. So I stay convicted, I stay disciplined, and continue to dollar cost average and don't give into that FOMO. And then some people panic sell. That's what I really want to guard against. Some people just think that the market's going to keep on falling and falling, and usually you hold off on feeling panicked, you hold off, and then by the time that you finally just decide now is enough, that's when we're at bottom, and that's where you sell to people that are buying the dips. Now, I do sometimes take profits. This can also be good too. If you're in a riskier investment, or when I make a riskier investment, I typically do take some profits along the way. Now, this can change a lot too. It's going to be dependent on what you're talking about. Is it the stock market? Is it crypto? How risky is it? Why is it pumping? There's so many different factors. If everyone knew when to exactly take profit, everyone would be making millions of dollars. So that is what you have to know. There are videos on YouTube about profit taking. A lot of the time you might just take maybe 5% off the top or 10% or 20%. You just sell part of your position as it goes up. Or let's say your investment goes in doubles. Maybe you take out your entire initial investment and then you're all good. Everything that's left in the crypto or the stock is just house money. It's just money that you've made by investing early and investing at the right time. And then if it goes down to zero, well, you didn't lose any money. If it goes up 10x from there, you're going to be kicking yourself that you took a little bit of profit, but you know in the back of your head that was probably a smart move. And then the last thing really that you have to pay attention to is money and how it affects your relationships. The goal is to become financially independent, but not everyone understands that. I thought my fiance, back when she was my girlfriend, would totally understand the FIRE movement, just like everyone that I thought that I had come across something magical, that everyone would be entranced like I was. They would put all their time and effort into becoming financially independent. But some people don't care about it. Some people just think that they're going to work forever. Some people like working and they don't mind working forever. So just know that everyone's in a different situation. Everyone has different paths. So just because someone else doesn't see what you see doesn't mean that they won't ever come around to it or that they're wrong necessarily. I like to try to educate, but some people just don't really like to think about finances at all. Some people just don't want to think about it because it stresses them out so much. And I'm around people like that. So that's where if you can take initiative and you can show, hey, I can really do this. I can invest for us. I can make our investments grow over time. And I'm taking on that responsibility, then maybe that takes some pressure off of your significant other or your parents or something like that. Just know that their risk tolerance might not be the same as yours. So just make it clear maybe how you want to invest or that you think you're doing the right thing. And then just try to not lose everything. I think that is what really affects relationships, is if someone invests for the couple, let's say, and then the price goes down in half, and this other person didn't want to be invested in that in the first place, let's say it's Bitcoin or cryptocurrency or some riskier stock, that's where it can cause a little bit of a drag on relationships. So just be cautious of that. But also know that usually if you're buying a really good asset like Bitcoin or like a really great company, there will be times where it falls 50%, and that's probably not the time that you want to sell. So just think about what you would do and what you would say to your significant other if they would be upset with you if that happened. Now, I appreciate everyone that have stayed through, either if I do publish this as a course or that has stayed through to watch this entire thing. If I just post it on YouTube, which I'm considering, thank you guys. I really appreciate you guys watching this far in. There are links underneath the video in case you want to give back. I mean, this was a big thing to shoot, a lot of videos. In case you want to give back in some way, you can check out the links underneath the video. A lot of them are affiliate links, and they're some of the companies I use. So I would really appreciate that. Otherwise, I hope you guys all have a great rest of your day, week, month, year, and I hope you continue to become financially independent. And if you want to share this to someone else, that also helps a lot too. Like sharing this or bookmarking it, rewatching it, sending parts to different people. I would really appreciate that. If you guys want me to cut it up into smaller pieces and post individual videos, let me know in the comment section. Beware of the scammers in the comment section as well. Hit subscribe and like, and I will see you in the next video. Bye.